An option strangle. One way to think about an option strangle is that you're strangling the price between a top and a bottom. You think it's going to be stuck in between that range, so you're strangling it in between there. That's if you're selling the strangle. If you're buying the strangle, you think it's going to it's going to get out of that range of price. Here I'm going to talk about selling a strangle. Okay, so let's take GM right now. Let's say you're looking at GM and you think, okay, this has got it made a low a few days ago down here around, let's call it $15. You don't think it's going to go back below there, and maybe you think this falling 20-day moving average is going to cap it off. So you think $25 is pretty much as high as it could go. Okay, so right now it's trading at 21.60. You think that the high is 25. You think the low is, say, 15. It's not going to get out of that range, so it's going to be strangled in there. Let's say your time frame for this is 2 weeks. You think in the next 2 weeks, there's no way GM's going to escape this range. It's going to trade in there. Okay. So one way to trade that then would be to go in here. You go in, look at your options. All right. So we're looking at April 9th. Right now, you can see that's 15 days out from us today. The implied volatility is pretty high right now. We're in the midst of a global pandemic, which has made volatility jump through the roof on just about everything. Normally, GM trading at 21.60, the $15 puts would be worth next to nothing. Nobody would expect that GM was going to fall, whatever that is, 30% in the next 2 weeks. So. But in this current market conditions, there is value there because the buyers of these puts do think that there's a good chance that GM could fall below that price. So anyways, if we're going to sell a strangle 2 weeks out, 15 days, that's our expiration. We're going to sell a $15 put. Okay, we don't think it's going to go below there. On the other hand, we also don't think it's going to go above $25. So we're going to sell a $25 call. So now this is our strangle, a 15.25 strangle expiring in 15 days. We don't think the price will escape this range. Somewhere in there is where it's going to expire. Okay. Currently, that the price for that is $1.10. Let's say that's what you can sell it for. So you're going to collect $1.10, $110 per strangle option, per spread that you make. You're going to collect $110. Okay. But what's your risk? On a strangle, your risk is virtually unlimited, okay? And so strangles are definitely not for beginning traders, and they're not for traders that don't have the capital to cover substantial risk either, okay? This is a high-risk trade, and there's just no two ways about it, okay? Right now, so what we're looking at, the stock, again, is at 21.66, so here we are in the middle here. The risk right now, what's the risk? Okay, the risk is that the stock collapses. Let's say it falls all the way to $10. If it fell to $10, what would happen? We're talking at expiration. In 15 days, it expired at $10. At that level, your $15 put's going to be worth $5. Your 25 call is going to be worth 0. Okay, so that goes out at 0. Great. But this, however, your 15 put now is worth $5. Okay. Unfortunately, you sold the spread for $1.10. Now you've lost $5 minus the $1.10 that you collected. So you lost $3.90 or $390 per spread at $10. It's kind of the same thing to the upside. If the stock explodes here, let's say it goes up to $30. Okay. At $30, your 25 calls worth $5. So that's worth $500 per spread. You collected $110. So your risk, not maximum, your risk, if the stock went and closed at $30, is you lost $3.90. $5, 500 minus the 110 that you already collected. Okay. In the meantime, right now you can see the deltas on this is 0.11. And the calls, it's 0.27. So you're a little bit short. It's basically a net short here, net short 16 deltas on this. What's going to happen with a strangle is basically as the stock, let's say the stock doesn't really move much. Let's say 6 days from now, it's still trading at $20. It dropped a little bit. It's trading at $20. It's still well within this range. What's going to happen is both of these options are going to decay, and probably the implied volatility is going to go down a little bit as well. Depending on the market conditions, the volatility, things. If the stock hasn't moved for a few days, that probably means things have settled down a little bit. So the value of these options is going to go down based on two things: the theta, the time decay. There's less time for a move through these strikes, so the price of the option is going to go down, as well as the volatility has gone down. So just basically, there's just less risk that those trades are going to happen. That the GM stock is going to trade through 15 or through 25. So as that happens, the value of these options is going to go down, which would bring the price of the strangle down, which is what you want, right? Because you sold it for $1.10, you collected that. Let's say the price 6 days from now, while the stock is at 20, is now down to probably 50 cents for the spread. Okay, so in which case you would have already made 60 cents or $60 per spread. And you can always close out early if you like, or if you're still feeling confident, you can continue to ride that and try to ride this premium right down to zero. That's the basics of a strangle. Again, this is a pretty advanced option strategy. I really wouldn't want to see any beginners take a trade like this, and I wouldn't want to see any traders that aren't pretty well capitalized doing this trade either. There is another way to do a similar trade, and I'll talk about that. That's called an iron condor, and I'll talk about that in another video.
Thanks for watching.